One of the most common questions I get asked when someone wants to start a business is which business entity should they use? Sole trader or limited liability company? Now in this video I'll talk about some of the differences between the two entities, and this should help you to decide which is the best option for you. When most people have decided to set up their own business, the first issue they encounter is, should I operate as a sole trader or start my own limited liability company? Now there are many factors to consider and many advantages and disadvantages to setting up as, well, either. The decision often depends on the personal preference of the person who owns and runs the business and the type of goods and services that they are providing. There is never one standard answer for all businesses. What is the difference? Here are some basic definitions describing a sole trader and a limited liability company. So a sole trader operates a business on their own. They can employ people, but the trader controls, manages and owns the business and obviously is entitled to all the profits. This person is fully liable for the company's debts and contracts, and there is no distinction in law between the business and them, the trader. Usually a sole trader business can be established, well, without any paperwork. A limited liability company. A company is formed and is a legal entity in its own right and separate from its owners, shareholders or directors. Shareholders' liability for losses is limited to their share of ownership of the company. The company is run by directors who act on behalf of the shareholders. Now, although in most businesses this is actually the same person. The limited liability company is New Zealand's most successful and most used business structure. Now I have included up here and in the description below the links to two videos that you should watch for a better understanding of a limited liability company and or a sole trader. Owner's liability. One of the biggest benefits of having a limited company structure instead of operating as a sole trader is that with a limited company, you have limited liability. A sole trader will be completely responsible for the business and its finances. A sole trader, the business owner and the business are treated as one under the eyes of the law. But with a limited company, the business itself is a separate legal entity. Business debts are the personal responsibility of the sole trader, whereas they stay within the limited liability company. If the business goes bust, the personal assets and the assets of the sole trader are in danger. Now this is because legally there's no difference between the sole trader's assets and the business assets. Now as well as finances, this will also apply to any legal disputes. A sole trader will need to have various comprehensive business insurance policies in place to avoid getting sued personally. Also makes sense for a company director to have these as well. But in the eyes of the law, the sole trader and the business are the same. Tax. No one wants to pay more tax than is absolutely necessary. A limited liability company has the advantage over sole traders insofar as a company is more tax efficient. Being a limited liability company enables accountants to structure the business affairs to save on income tax and utilize the other claimable expenses allowed. The use of dividends, sensible payroll planning often means that business owners can make a substantial tax saving. At the end of the financial year, both a sole trader and a company must complete a tax return and submit it to Inland Revenue. Perception. A limited company may come across to a business as a better model to work with than a sole trader. Businesses, contractors, clients, etc. are more likely to want to work with a limited company as their perception is that a limited company is, well, more professional. A limited company can build a good reputation, which makes it more credible in the market and certainly way more saleable when it comes time to move on. Accounts. Both sole traders and companies will need to prepare tax accounts and submit a tax return each year. There may also be a need to submit GST and/or provisional tax returns depending on the size and amount of revenue the business has. The company directors must also ensure that the company complies with the Companies Act, including keeping a company register and maintaining the relevant records. As a result, accountancy and administration costs are likely to be higher for a limited company than a sole trader. Now, I've said this before many times, but it is important that you get the right advice, especially when it comes to tax and financial matters. I strongly suggest you talk to an accounting professional to help you get it right before you decide which is right for you. A sole trader legal structure for a business is the easiest to set up, and that's why it's proven to be such a popular option. However, there are clear advantages to running your business through a limited company structure. So before deciding, it's important that all factors are considered to ensure that you have weighed up the pros and cons of which legal structure and decide what fits you and your business best. Thanks again for watching. If you want to see more, hit that subscribe button. Till next time, see you then.